Hi, I'm Lee Hyde with Shepherd Financial, and this is the Monthly Minute. As we get closer to tax day, you might find yourself asking, are there any ways I can save money on taxes from last year? Well, you're in luck because there are. The first is just what's called a traditional IRA. You may be familiar, but a traditional IRA is a way to save money tax deferred, but it also goes in pre-tax. So what does that mean for you and your taxes? Well, let's use an example. Let's say you're married, you're under 50, you're self-employed, and your AGI or adjusted gross income's going to be $150,000. Well, you and your spouse can save $12,000, so that would be $6,000 per person because you're under 50. If you were over 50, it would be $7,000 per person or $14,000 for your family. But that's going to reduce your taxable income from $150,000 to $138,000 by saving that $12,000 into your IRAs. That will save you about $2,600 on your taxes. So the benefit there is it's going to obviously give you some long-term retirement savings, but save you about $2,600 in taxes. The next way would be through what's called a health savings account or an HSA. We've talked about HSAs before, but it works the same as a traditional IRA. That money goes in pre-tax, so every dollar you save is a dollar that your income is reduced for that year. The limits again are $3,600 for 2021 for under 50, $7,200 for family, and if you're over 50, you get an additional $1,000 that can go on top of that. So it'd be $8,200 for a family. But what if you just want to save for retirement? You're not as concerned about taxes today. You also can save into what's called Roth IRA, and it's essentially the reverse of a traditional IRA. Instead of getting the tax benefit on the front end, you get it on the back end. So as you pull money out of your Roth IRA, you get it out tax-free. The limits are the same, $6,000 per person under 50, $7,000 per person for 50 plus. And the nice thing is you have until you file your taxes this year. So tax filing day is April 18th this year. You also could file for an extension, but you have up until you file your taxes to make those contributions. So worth considering, but before you do that, did you know there are some limitations on who can contribute to these accounts? So that's going to be based on your income, whether or not you have access to an employer-sponsored retirement plan. So before doing that, I would recommend that you consult your financial planner, CPA, or at least do some research on your own. I hope this has been helpful. Check back in next month for more helpful tips. Thanks.